Namaste. Today in this video, I'm going to share one trick with you which will help you to understand and also learn the golden rules of debit and credit. The trick is consider debit as dancing and credit as crying. Now before I start applying this trick to all the golden rules of debit and credit, let's understand the types of accounts. Under these we have personal account. Under personal account, there could be natural account, artificial account or representative account. Example of personal account like Mr. Ram account, any person's account, any company's account or rent due to landlord's account. Then we have real account. Under this, all the assets account comes. Assets means furniture account, machinery account, factory account. Then comes the nominal account. Nominal account includes all the expenses and losses, all the gains and incomes. Example like rent paid, salary to staff account or commission received account. Then we have liability account. Under this account, all the loans or borrowings from outside, from bank are included. Like suppose example is loan from the bank. Then we have the capital account. Capital account means the person who has invested money into the business. So it is actually the owner's fund, the owner of the company's money invested. So example is owner's fund or owner's equity. Now the interesting part is if you'll find any of the books, you'll see that the personal account have one rule, real account have also two rules, nominal account have two rules, liability account and capital account both have one rule each, and the rule goes same for the liability account and the capital account. Now I will tell you the trick of crying and dancing which can be applied to all these accounts and how. Now suppose first I'll take the personal account. Personal account means any person's account or any company's account. Now what does the rule say for the personal account? It says debit the receiver, credit the giver. Now how to learn this? It is very simple. I say Mr. Ram will be happy, he will be dancing if he gets something. Okay, so he will be debit, dancing when he is receiving something. He will be crying, okay, credit when he is giving something. Let's take an example. We say paid cash to Ram. That means Mr. Ram has received cash. So Mr. Ram will be happy. He will be dancing. Ram account will be on the debit side. The journal entry will be Ram account debit to cash account. Alright. So Ram account dancing. From why is he dancing? Because he has received cash. So Ram account debit to cash account. So this trick goes for the personal account. Dancing when receiving, debit when receiving, crying when giving, credit when giving. Next one comes the assets account. Now the rule says debit what comes in, rule number 1, and credit what goes out. There is another rule which says debit when there is increase in assets, credit when there is decrease in assets. Now how to learn these rules? Don't even learn, I say, just understand. Okay, I say for the assets account, I take a party. I say all the assets have walked into the party. So they are happy, they are increasing in number, they are dancing. Okay, when the party is over, they are walking out of the party and they are crying and they are decreasing in number. So the rule goes, party starts, assets walked in and they are dancing. They are happy, they are enjoying. Party is over, assets are out and they are crying. They are credit. Let's take an example. I say purchased factory in cash. Now in this case, you'll see factory and cash. Both are assets. So let's suppose I take factory account first. So I say factory has walked in because I have purchased factory. Factory has walked in the party. It will be on the debit side. Cash has walked out. We have given cash to purchase factory. So cash has walked out and it is crying. So it will be on the credit side. The journal entry will be factory account debit to cash account. So for the assets, the trick of crying and dancing, you have to keep in mind the party rule. Next comes the liability account. The rule says debit when there is decrease in liability and credit when there is an increase in liability. Now how to understand or apply a trick of crying and dancing here. The loan or liability is always a headache for everyone. Okay, so I say when I have borrowed a money or I have taken a loan or my loan has increased, I have a headache to pay it back. Of course, I will be crying. All right. Now, if I have repaid that loan, okay, or I have fully finished it, or I have paid part payment of my bank loan, I have a less headache to pay. So I will be dancing. Now, how will I apply this to a journal entry? Suppose I take an example of loan taken from a bank. It could be my new loan or it could be an additional loan to my existing one. So my bank loan account will be on the credit side. I am crying because my liability has increased. So bank loan account will be on the credit side. So what would be the journal entry? Bank account debit to bank loan account. Why bank account is debit? Because bank when gives us loan, it will not give us directly in cash. It will transfer it to our bank account. So my bank account has increased. It is an asset. It has walked in the party. Okay. So it is dancing. So bank account debit to bank loan account. Bank loan is my liability. I will be crying. So it is on the credit side. Now the same rule of liability account goes for the capital account also, because capital is a liability for the business. Okay, business has to pay it back to its owner, this money. Now the rule again says the same, debit when there is decrease in capital account and credit when there is increase in capital. So capital is a liability of a business and it is the money put by the owner of the business for the business. Again the same rule goes, capital has increased, okay, and or it has increased or there is a new introduction of capital into the business, either of the cases. The liability of the business has also increased. It is now a headache for the business to pay it back to the owner. Okay, so he will be crying. Who will be crying? My capital account. All right, now capital has decreased. How it can be decreased? Suppose the owner of the business has withdrawn some money for his personal use. So the liability of the business has also decreased. All right, now the business have to pay less capital to the owner because the capital is withdrawn. Some money has been withdrawn, it has decreased. So it is a less headache to pay back and the capital account will be dancing. Let's take an example. Ram started business with cash. So Ram is the owner of the business. He has invested money into the business. So it is a capital for the business. So capital account will be now crying. Okay. And here the cash has walked into the business. It has walked into the party. So it is an asset account. It will be on the debit side. My journal entry will be cash account debit to capital account. Next comes the nominal accounts. Now nominal accounts have expenses and losses account and incomes and gains account. Now let's take first expenses and losses account. The rule says, number one rule says, debit all expenses and losses. Debit when there is increase in expenses and losses. I call nominal accounts as crazy accounts. Why? Because they just work in an opposite manner. How? See, whenever somebody is making an expense or has incurred a loss, he will not be dancing. For sure, the personal account, the assets account will not be dancing. They will be rather crying. But my expenses account are crazy account. Okay, they just work in an opposite manner. The expenses when are made or expenses have increased, they will start dancing. They will be on the debit side. They will cry when there is less in the expenses or the expenses has decreased. Okay, let's take an example. Rent paid in cash. Rent paid is my expense account. So rent paid account will be on the debit side. We have paid cash. Cash has walked out of the party. So it is on the credit side. The journal entry will be rent paid account debit to cash account. Then under nominal account, the second one comes is incomes and gains account. The rule says credit all incomes and gains. Credit when there is increase in incomes and gains. Now again, if I am going to get my income, my salary, or I am having a profit in my business as a personal account, I will be happy, I will be dancing. But again, income and gains account are a part of nominal account. They are crazy account. They will just do the opposite. So they will start crying. The revenues, when we get the revenue or my revenue has increased, in both the cases, it will start crying. It will dance when it is less, okay, when I have not made a revenue, okay, or my revenue have decreased, I will be dancing. Alright, so I'll take an example. Interest received on fixed deposit from bank. Okay, interest received is my income account and I'm going to get this money from a bank deposit. So I am crying. My income is a crazy account, part of nominal account. It goes opposite. So it will start crying. Bank account will be debit. Why? Again, because the money whichever I'm getting from interest is put into my bank account. So my bank account is increasing. Okay, it has walked into the party. It is an asset. So bank account will be debit to interest received account, which is on the credit side. Now if I talk about the summary of all this dancing and crying trick, I come to types of accounts and I say dance and cry. Alright, now for the assets account, I say whenever there is a increase in number or my assets are coming in, okay, they are purchased, they are dancing, they are on the debit side. Whenever they are decreasing in number, my assets, or they are sold, alright, so we have credit. Assets will be on the credit side. Liability, capital account, both, for both the cases, I will be dancing when there is a decrease in my liability. I will be crying when there is an increase in my liability. For the revenues, incomes, profits or gains, expenses or losses account, they all are part of nominal account. So for the nominal account, it just goes the opposite. So for the revenues and incomes, I will be dancing when there is decrease. I will be crying when there is increase. Same goes for expenses and losses, opposite way. I will start dancing when there is increase in my expenses or there is a loss. I will cry when there is decrease, okay, in my expenses and losses. I hope this trick of dancing and crying had really helped you. And please, I request you to share this trick with at least 2 of your friends, because I know students are really facing a problem in understanding this debit and credit. Alright, and please write to me in comment box if you have any better idea than this, dancing and crying trick. Thank you so much for watching this video. Namaskar.